A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are aged 62 years or older. The unique features of a HECM make it a valuable tool in retirement planning and aging in place. Sometimes it's hard to describe what this product is, and it's better if you'd see a few examples. So here are a few people suitably disguised from the real world who took a HECM and why they did it and how it helped them. So meet Molly and George. George was 75, he was already retired, and Molly was 72, but she was still working. She was working because she had to make the monthly mortgage payment of $2,000. She wanted to stop work. Their home was worth about $500,000. She had debt on it of about $150,000 and a monthly payment, as I said, of around $2,000. Molly, being the youngest at 72, qualified for the HECM of $300,000 on the home value of $500,000. Using those proceeds, they paid off $150,000 of the mortgage and set up a line of credit for the remaining $150,000. Overall, they saved themselves $2,000 a month on outgoing cash, and then arbitrarily took a payment of $1,250 a month to help supplement the loss of Molly's income for a total monthly cash-in of $3,250. This was basically Molly's net after tax when she was working. But now she was able to retire and enjoy that retirement in her home with her husband. In this example, we have John and Kate. They're both retired, but they don't quite have enough monthly cash flow to really relax and enjoy themselves. And on top of this, they suddenly have a medical emergency. Their home was worth $400,000, so they decided they would get a reverse mortgage. So John is the youngest here, and he qualifies for a $219,000 HECM on the $400,000 home. They pay off their emergency bills, and they're left with about $190,000 in a line of credit. Now they can use this line of credit in three different ways. They can leave it where it is and let it grow if unused. They can elect to get a monthly term payment, which will expire when the principal limit or the gross loan amount is used up, which is estimated to be at the end of the remaining life for John, and gives them credit for the annual unused portion of the line. Or they can take a monthly 10-year payment, which is a guaranteed annuity-type payment by HUD to be paid monthly to them regardless of their age, and also regardless if there is any availability left in the line at the end of the day. In other words, if the gross loan amount has been used up by all of the 10-year payments, they can continue to receive the payment until the last person leaves the home. A 10-year payment is calculated on the age of the youngest borrower and assumes that they will live until around 100 years of age. The advantage is that if you live beyond the 100 years of age, even if there is no gross loan or principal limit left, HUD guarantees you will receive this payment until you leave the home. Our next example involves Rich. Rich's retired. He's not married. He's considering moving closer to his family, preferably to a retirement community, or possibly upgrading his existing home so that he can age in place in that home. His home was worth around $400,000. He has no mortgage. The upgrade costs to make it suitable to age in place are around $150,000, and he believes he can find a home close to his family that meets his needs for around $600,000. So Rich has a choice. He can upgrade, or he can buy a more expensive home close to his family. Upgrading gets him a line of credit of $235,000, which is more than he needs on his existing home. And he gets that with an optional mortgage repayment plan, so he doesn't have to make the monthly payments if he doesn't feel like it. The other option, of course, is he can use a HECM for purchase and buy that dream home that he wants. Rich opted to buy his dream home. He sold his current home for $400,000, kept $150,000 in cash, put it in the bank, and he invested the remaining $250,000 in a new home. He applied for and got a HECM for purchase for $350,000, and that, plus his $250,000 down payment, allowed him to buy his $600,000 dream home. It's important to understand that a HECM for purchase is not limited in the first 12 months disbursements, as are traditional HECMs, where we're refinancing an existing mortgage or possibly taking cash out. HECMs for purchase allow you to use the entire HECM proceeds to buy a new home. Rich also paid a very high 2.5% of the appraised amount of the home, or $15,000, in upfront mortgage insurance premium on the transaction. He thought about that as an additional purchase price on his house, and worth it because of the optional payment plan feature and because he got a home close to his kids that he could age in place. Our next example is Mary, a widower. Mary had a pension, Social Security, and some savings, but she had recently learned that the average older person can pay as much as $250,000 in nursing home care, medical premiums, and deductibles during the course of their remaining life. Mary didn't need the money immediately, but she didn't want to be forced from her home either someday if an emergency arose. She owned her home outright, which was worth $400,000, and decided that she needed to build up some financial capacity using a HECM. So Mary qualified on our $400,000 home appraisal for a HECM line of credit of around $203,000. Because the program assumes that Mary would draw the money immediately and never make a payment, they set aside $197,000 of her appraisal amount as a reserve for future unpaid mortgage insurance and interest. If Mary did want to pull the money out suddenly and immediately, she would only be allowed to pull out 60% of the $203,000 in the first 12 months, unless she could justify some form of medical emergency. But if Mary did not use any of the proceeds, the line of credit would grow and increase annually at the rate of interest and the mortgage insurance. So what happened after 5 years of Mary not using the line of credit? Her line of credit had grown to $269,000. That's because $66,000 less interest and mortgage insurance reserve was needed because Mary did not draw the money. If we don't need the money set aside, we credit it back to her available line of credit. The HECM growing credit line availability, if unused, is an excellent way to hedge future unexpected costs. I hope these examples have been useful to you. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.